Hey everybody, Serge Berger here from the Steady Wealth Podcast. I am coming at you today from Orlando, Florida, and we are here to talk about juicy bond ETFs. Juicy because they can generate a lot of yield. Now, before we talk about a whole bunch of these bond ETFs and how they can fit into a portfolio, I want to talk to you about something that just happened to me literally yesterday, as I'm recording this yesterday, and it has to do with a big roller coaster here in Orlando, Florida. There are lots of theme parks, and theme parks tend to have roller coasters. And I went to SeaWorld, which is one of the theme parks here, and SeaWorld has a bunch of really big roller coasters. And after watching all the dolphin shows and the orca shows and those kinds of things, our 12-year-old daughter convinced me to go on one of the big roller coasters, and big. And without any sort of major health hazards, we survived this thing. But I was reminded of a story about the markets. How else could I get through a roller coaster without thinking about risk, right? And this is one of those roller coasters. The one we went on, it's called something Mako. I think Mako, Mako, if you want to Google it. It looks a lot less bad on YouTube, by the way. In hindsight, I watched that YouTube video and it really just didn't look very bad, but it was quite something while we were doing it. Long story short, this is one of those roller coasters where it goes up really, really steep to one of the highest points in Orlando. It's the highest, it's the fastest, and it's the longest roller coaster in Orlando, and there's some crazy ones here in Orlando. Anyway, so it goes up really steep and then it basically drops vertically, and then it goes through a series of rolling hills. I don't know how to better describe that. I'm not a roller coaster advocate. And because this roller coaster is so fast, again, it's the fastest one here in Orlando, and I think that says something. Every time when you go down into one of the bottoms of the loops, if you will, it pushes you into the seat. But of course, when you get to the top of one of those loops or rolling hills, it has the opposite effect where it basically pulls you almost out of the seat. Of course, you're securely fastened in this whole contraption. But because this roller coaster is so fast, that gravity pull or whatever you want to call that, this is, I guess I need to go back to physics class to figure out the official terminology. It really tries to pull you out of the seat at the worst possible time, at the very top of these peaks. And if all I could think about, as much as this was a fun roller coaster, I was just thinking from a risk perspective, what if that sort of seat belt or whatever, that contraption that keeps you inside the seat, if that were to give literally when you're at the top, when there's maximum weight pushing against it, meaning my weight pushing against it, and then you just basically go catapulting out of this thing and basically splat. And it got me thinking about the markets. And the reason this got me thinking about the markets is because I just think that there's so many people out there right now that are absolutely not thinking about the risk. And I can guarantee you, most people that go on these roller coasters don't think about risk. And obviously, this is not a direct comparison. The roller coasters have a very low accident rate, but of course they happen. So my point is, it's worth thinking about risk both on roller coasters. Just at least consider it. Not, obviously very few things happen, but things do happen. But also in the portfolio. And a portfolio has a lot more risk than a roller coaster. For the most part, many more accidents happen in portfolios to people's savings. Now, I'm not talking about their trading account, right? We always talk about this here at the Steady Trader, or of course at Blue Marlin, which is our investment advisory firm. We always talk about the importance of trading with money one can afford to lose. One needs to have a base foundation of investments. And then certainly if one wants to trade self-directed, presumably if you're listening to this podcast, you are at least to some extent a self-directed investor, maybe even more so a self-directed trader. What we have found is predominantly the self-directed investors, and even of course those with investment advisors, tend not to be diversified properly. There are studies after studies, and they've become more and more prominent. Even just over the past month, earlier in July, I read a study about the average American just being an average American over 70, basically, not 100%, but basically being in all equities. And we always talk about this internally. I think the problem that this brings about is the severe drawdown at the worst possible time. If you're listening to this right now and you are in 100% equities in your portfolio, I would encourage you to have a seatbelt, right? Or in the roller coaster example, one of those things that really straps you into the seat when things go bad. And so the way to do that is multiple ways, of course, but the core principle of it is through diversification. Now, I just got off a call with one of our internal clients where we work with to construct portfolios at Blue Marlin, and it's just incredible. It really is incredible how long it takes for people to usually make changes to a portfolio when there's been a drawdown. And so this year, we're once again seeing a few heavyweight, good company tech stocks blasting off to the top, taking the indices with them. The broader market has caught up a little bit, but it's nowhere near where the rest of the market is, where those few stocks are. And so it's clouding people's perception of the need for a diversified portfolio. Because yes, if all one owned is a few tech stocks, and which ones I'm talking about this year, one would have and maybe did make a lot of money. However, with all that potential upside also comes a lot of risk when volatility returns. And this is not a doom and gloom call. This is simply just historically, factually proven that if one has a diversified portfolio, and when I say diversified, I don't mean every single penny is distributed. I'm talking about the core of one's net worth, be that in various different equities, different sectors, different countries, maybe different currencies even possibly, and of course different asset classes. So that means investing in equities makes sense for most people, investing in fixed income markets, and that's what we're going to talk about today through a few ETFs that I'd like to showcase to you. Real estate comes to mind, right? Alternative investments for those people that qualify, and if your investment advisor agrees with you. We have these discussions a lot with clients. Does it make sense to put alternative investments into a portfolio? So a diversified portfolio is going to weather the storm a lot better on average over the longer term. But if an all equities portfolio, which again, a lot of Americans have right now, is basically all equity portfolios. And again, I'm not talking about 30-year-olds. I'm talking about 60, 70 plus year old people, investors that simply haven't seen a significant enough drawdown in their portfolio for 10, 12 years to really care just yet about what happens when you have a portfolio drawdown. Ironically, most people's portfolio have not made money for 2.5 years. That's another thing to keep in mind. Most people are flat, even though a few stocks are up this year and the S&P is up and the Nasdaq's up. Most people are basically flat for 2 years, nonetheless. However, and this is where we now get to the fat pitch, I think the bond market offers a lot of opportunity. Now, let me qualify that. I have personally been on the wrong side of the bond market in terms of directionality. I really thought that by now the economy would have slowed more than it has. It clearly hasn't slowed enough yet for the bond market to go higher, meaning bond prices higher, bond yields lower. That has not worked. And I still have some trades open in directionality, but I think until we get that point where we get a real crack in the economy, and it can happen any day now. That's the thing, right? So I still have some exposure to it. But I think much more importantly, and this gets us to the diversification point, is to look at the bond market. Anyway, long story short, yield in terms of yield is extremely important. And so yield in a portfolio is important, not only because it gives us yield, right? So bonds pay a coupon, or bond ETFs, which we're going to look at here, pay us a dividend, so to speak, but also because of diversification. Right? Now, of course, lots of people look at 2022 as a year where both bonds were down and equities were down. It was a big anomaly. It has almost never it's happened a few times before, but over the grand scheme of things, over long periods of time, it rarely happens, and it can happen sometimes. But the diversification need here is important. So let's talk about some individual bond ETFs that I think are worth considering. Remember, I'm not giving you investment advice here. These are simply bond ETFs that I think are worth being talked about. Let's start off with the most popular one, or maybe the most widely held one, and that one is the ticker symbol is TLT. Theodore, Lenny, Theodore. You can tell I've never been never learned exactly how to pronounce those individual letters, but TLT I think is an important one to be aware of. Now, again, TLT is an ETF that not only will make money if it goes back up, meaning bond yields go down, but I think much more importantly right now, it's an ETF that pays us a coupon. In fact, it's really a dividend. So what these bond ETFs do is they buy bonds of different types. Each ETF has a bit of a different composure. And then because the ETF then receives bond coupons being paid, because it holds the bonds, it then distributes those bond holdings, those coupons through like dividends to the ultimate end investor like myself, if I own those. And I own a bunch of these ETFs as well, by the way, in full disclosure, right? So something like TLT right now, as I'm recording this here in late July, and of course this fluctuates every day, is yielding roughly 4%, give or take 4%. Now, obviously, someone that buys whatever NVIDIA a few months ago and says percent per year, what's that? Is saying that's nothing. What those people are forgetting is the risk. So TLT is a good one in my view. Again, not a recommendation, just an ETF that I personally own that I think makes sense. Not so much in terms of directionality right now, although I do think the bond market ultimately will bounce when there's more headlines about the economy slowing, and it is slowing, by the way. So that will go up, but it's the dividend right now, the yield that I'm really want to build into a portfolio. I personally have that in my portfolio. We have it in client portfolios as well at Blue Marlin, and over at the Steady Trader, we do have it as an allocation idea out there as well that we think people should be allocating some of these. But TLT specifically is an ETF that allocates to the bond market, the U.S. Treasury market, 20 to bonds that are 20 years or more to maturity. So it's what's called the long end of the yield curve, and typically that tends to yield more than the short end. Ironically, we right now have what's called an inverted yield curve, where the short end of the yield curve, like 2-year notes, yield more than the long end of the yield curve. So 2-year notes right now yield about 5%, let's call it that, give or take. The 20 plus year ETF, the TLT, yields about 4%. So you're looking at 100 basis points of spread. And so you might be asking, Serge, why the hell buy TLT if I can buy a shorter end yield? Because you want to have diversification as well. So I practice what I preach. I like to have diversification in the bond market, just like I have diversification in the equity market, because I know ultimately that is going to allow me to weather the storms as we see volatility come back in the market. So TLT is one of them. Again, not a recommendation. I'm not legally out there to do a recommendation through a podcast, but it's an idea that I like. Another one is an ETF that goes by the ticker symbol of SHY. There's also another one very similar, SHV and SHY. I'm going to refer to the SHV ETF here, but SHV currently yields about 5%. Let me just quickly double check something. And it's the short end of the yield curve. So you're looking at right now in this inverted yield curve environment, you're looking at making more yield on shorter dated bonds or notes than in longer term ones, because the yield curve is inverted, meaning it's downward sloping. Longer term yields that give you less yield than shorter term. Now, at some point, this yield curve will go back into it's downward sloping. This is the roller coaster I was telling you about. Is going to basically reinvert into going back into a regular normal yield curve, which means lower bond yields, shorter dated bond yields are going to yield less than longer term. It's called an upward sloping yield curve, normal yield curve, whatever. Those are two ETFs I think are quite benchmarked. Another one that's very popular, kind of like a mix of it all. It's the ETF. So we covered TLT, the longer end of the yield curve, SH for shorter end, something called the AG. Ticker symbol is AGG. It stands for the aggregate bond index. It's an ETF actually that basically takes advantage of the kind of the whole yield curve, and the aggregate bond market ETF AGG kind of diversifies into a whole bunch of bonds across different maturities, and that allows us as an investor to take advantage and invest in the entire bond market, U.S. bond market, through one investment, as opposed to buying different ETFs for different parts of the yield curve. So you might be asking yourself, why buy individual ones if I can buy one that kind of takes care of it all? Again, here what we're looking at is essentially is maybe making more refined bets in one part of the yield curve than others. Again, since I'm not allowed to give you a recommendation here, we do that over at Blue Marlin Advisors. If you're interested in talking to us at Blue Marlin, we'd be happy to work that out for you. Otherwise, I'm just trying to tell you here there is different reasons for different ETFs. Also, what the aggregate bond ETF also does is it actually also invests in various government-backed securities like mortgage-backed securities, corporate bonds. I think the main issue of corporate bonds that this ETF has exposure to is Wells Fargo, Morgan Stanley, JP Morgan, and Bank of America, so bank bonds. So again, AGG is another one that I think is interesting. And then really, there's really kind of, the sky is the limit here as we look at the bond ETF universe. There's so many of them. But there is one other one that I would like to mention, and the ticker symbol, and I've mentioned this before on the podcast, by the way, and the ticker symbol is JPST. JPST. It's a JP Morgan Ultra Short Income ETF. Now, the reason why I like to invest, and I'm invested in this, by the way, JPST, why one would invest in this is because of the yield right now. So this is a little bit similar to the idea of why one would invest in SHV or SHY, the shorter end of the yield curve. What's nice about this JPST, and by the way, I should make one disclosure. This is really important, and I should have done this before. The ETFs that I'm talking about here are, none of this is endorsement. Like, I'm not being paid by the companies. Okay, this is basically just my analysis. We're not being paid by, in this case, JP Morgan or iShares or whatever the other ETFs were that I mentioned. No sponsorship here, right? This is just so you know, it's not an advertisement for those. I'm not getting any kickback, nothing. It's just is what it is. JPST, JPST as in Theodore, is a really interesting ETF. Now, again, it's short dated, but it invests in short dated obligations, or basically short dated paper. So basically what you're looking at is it's a money market fund, is the plain English term for it. I'm looking at some of the top holdings right now. Things like, there's a few banks in there, Wells Fargo. There's it looks like AT&T. Again, a lot of short dated stuff that expires. I think their average duration right now is probably about 6 months, something like that. So it's very short dated. Now, why is this interesting? It's interesting because these are short dated corporate obligations of high quality issuers. It's not no high yield, none of that. And so the yield right now, as I am recording this here in late July, the yield is roughly about 5.5%. Again, don't quote me on this. It depends on when you watch this, but it's about 5.5% is the yield on this this ETF. And this is maybe the best thing for some people. Again, you got to consult with your investment advisor or get in touch with Blue Marlin, of course. This thing pays a dividend, like the coupons that it receives from its bond holdings, every single month. I'm just looking at the distribution here, the dividend distribution. So basically every single month they pay a dividend. So for investors that are looking for monthly income, literally, this is certainly something that I think is quite interesting to note. And the way to weather storms in general in portfolios is all about diversification. Again, this gets us back to the roller coaster example over here, serial that I was talking about before at the beginning of the show. The more we can diversify, and I know this is falling on a lot of deaf ears still, because again, everyone's riding high on their latest NVIDIA trade and they bought this and that. That's great. And again, we're all for that. 20-30% of a portfolio, if it makes sense for the individual investor, by all means, trade. The rest of it has got to be diversified. And this is, by the way, this is not me. I've only done this for 25 years. There's people have done it for a lot longer. Not to quote the big ones, but I will. Listen to the words of Warren Buffett. Listen to the words of other famous investors, big houses, big investors that have run funds for many years, hedge fund investors. They will all tell you the same thing: diversification. And unless one has a foundational, has a rock solid foundation of a portfolio, it is very difficult not to have drawdowns of 20, 30, 40, 50, 60% when markets get rockier. Some people have experienced some of that last year. when crypto fell apart and some of the non-profitable tech, but have gotten bailed out again by a few stocks rallying. Drawdowns happen, and they happen at the worst possible time in life usually. And so diversification, and I know, again, it's falling in deaf ears right now, but I wanted to make another podcast, and I'm going to continue making podcasts about this as well in the future. Diversification is the only way to ultimately grow money at a steadier level. Because if you have a drawdown of 20 or 10% as opposed to a drawdown of 40 or 50%, which again is very normal for a lot of people that particularly hold equities, that makes a huge difference over time. So that is my word on a few bond ETFs. Again, TLT is one interesting one. SHY or SHV is another one. AGG, the aggregate bond market index, that one kind of covers it all. And then again, JPST, an interesting one that actually pays out monthly. So again, just some ideas. I hope this is helpful, folks. You can head on over to thesteadytrader.com if you're interested in our market and trading research. If you're looking for an investment advisor, you'd like to talk to an investment advisor about your allocation, your portfolio, or if you need a trading advisor to actually talk to you with ideas throughout the month, throughout the year, you can go over to www.bluemarlinadvisor.com. Thanks for listening, folks, and we'll see you again in the next Steady Wealth podcast.